In this market environment, I've been enjoying a very interesting contradictory dichotomy. I feel like a genius and an idiot simultaneously. I feel like a genius because we've been making money. Good win rate, following the price action on the market, staying flexible, and it's played out very well. But I also feel like an idiot because none of my macro theses, or a lot of my predictions that I even have for this market, have played out whatsoever. On the micro level, when it comes to following specific companies, been doing really well. But the macro right now just seems to be slowly creeping away from me. And I'm trying my best to get a better grip on that. I'm trying to understand what's going on right now in this market that largely seems driven by sentiment. And we've been talking about this over the last several weekly reports as well. But I've also been letting a lot of these thoughts solidify and coming to some better conclusions that I think are more developed since I've had some time to really let them saturate. And to be fair, the video that I put out on January 31st, and I actually originally put this out on the 18th, then I re-uploaded it with a better cover photo and title, ended up doing double the views. So hey, finally figuring out this stuff. Although like ratio still awful. Hey, please like the video. It helps so much when you like the video. But a lot of what I covered in that video actually played out, and I think that video will actually be valid for several more months. But the big thing to talk about right now is what would cause the Fed to pivot, and that's what I want to cover. When the year first started, there was this big conversation, and we talked about this lots, of how bad will the recession be. And right now, the consensus seems to be all in on the conclusion that it's going to be a mild recession. I can't help but think, though, that the Fed is still tightening, doing all the practices of monetary tightening, and rolling off the balance sheet, etc., into what is already an economic slowdown. How is that mild recession not going to have a steeper drop off on the tail end due to these factors? The Fed already knows there's going to be a recession, yet they still haven't paused. And we know when we do historical analysis, reference that video that I just mentioned, we know that it takes about 6 months for interest rates to play out. And it seems to me like the Fed is already reacting too late. We've seen lots of companies cutting jobs and cutting back expenses, and we've seen that the market has rewarded them heavily for this. I mean, just think about the movement we saw from Meta, from doing job cuts, cutting back expenses, and the stock absolutely exploded. Now, part of that was also share buybacks, but we've seen the trend play out pretty much across the board in all technology companies. And this is them preparing for an economic slowdown. However, I don't see much preparation from the Fed for the slowdown that is definitely going to occur from all these companies pulling back on their spending and cutting the jobs. Instead, the Fed is continuing to tighten. And so even though right now sentiment is really good, people seem really excited. They're saying the market's going to head for 440. I think it could in the short term. Although in the immediate term, I think this market seems to be showing some signs of turning over. Maybe a retest at 400. We'll talk about this over the chart in just a moment. I think that later in the year, we could see a dramatic shift in sentiment. Now, I could be wrong. There is a camp of people who think the recession has already occurred. It's already passed. They are perma-bullish right now, and they think 440 is just the beginning of the rally that's about to commence in the market. And they think that people will FOMO into it and send us to incredible new highs. And they think the economy's fine. They think the Fed will safely land the market. And I think that they're a little crazy and getting carried away with their sentiment. Something that I definitely don't want to do just because the charts are green right now. Market's up. Everything's fine. Everything's dandy forever and always. Yeah, I don't think so. And if you've been watching my content for a while, you probably remember about a year ago from now in the weekly reports, I was talking about, hey, a recession's going to be in the future. Here's some of the things to watch about recessions. And one of the things that I mentioned a lot was that when you see those job numbers really start to fall off, that's usually the end of the recession, and that usually is near the bottom of the market. And that's the great signal. And I was trying to use that as a signal for the bottom of the market that we had last year. Now, Elliott Waves ended up giving us that bottom, which played out really well. I think we timed the bottom extremely well, actually. And in fact, I think we're going to do the same thing this year. But one of the things that people are saying right now is that since the jobs cuts are happening right now, that the recession has already passed. We're already seeing the job cuts. We're already seeing companies pull back. We've already seen the lows. They're already priced in. The recession's already occurred. No. What we want to see is the actual jobs numbers on our economic data point that comes out once a month and is backward looking, remember. We want to see that actually show some pain, and it hasn't. Instead, everything's been really strong, signaling a mild recession right now. But like I said before, I don't think that's going to be what persists. I think the dramatic shift that's going to need to occur for us to come to the realization of what could be ahead could mean some more dramatic selling than what is expected right now in this market. But remember, and I've already made this mistake this year actually, like we should have even bigger wins than I've already had. I've been already doing really well this year, but it's actually been cut short a little bit because I've been shorter when I should have been longer, because I'm using this long-term thesis to feed my short-term trades when I shouldn't. And this is such an easy mistake to fall into. It's really important that I don't. And I think that if you're a trader, it's something to keep in mind as well. Don't let what could happen in 6 months stop you from acting on something that'll happen in just 3 weeks. But at the same time, don't get caught up in a rally getting too long when you know in the future that there's going to be more lows. I think in the market right now like this, where sentiment is the main driver for us to keep going up, it's not going to take much for that to tumble down. Remember, this is a trend that we see all the time. The market climbs a mountain of worry and then sells off and plummets on some bad news. So even though at this moment, I can't think of what would cause that sell off, I can't conceptualize something that would be a high enough probability for me to act on it. I do want to be aware that this could happen. And for that reason, even though I'm long right now, I definitely want to have some hedges. And with all that out of the way, let's actually look at some charts. But real quick, I do also want to say that I am still doing the 1,000 account challenge, trying to take $1,000, turn it to 10,000. This account was actually in the red for a moment, which really sucks because I came in too heavy on UNG and actually did a lot of bleeding there, did a lot of management. We're now back in the profit range, although we did bleed a little bit on UNG today and did take some minor losses on SPY. Ended up getting out of that really quick. As you can see, only took a $4 loss on that today. It's not a big deal. The main account's been doing really well, but with this small account, I really haven't been trading much in it. And that's why I haven't had any major videos on this, because I've just left some bigger positions. I will start to make sure that I actually trade in this more. However, we've just been slinging out the wins, and I've been buying contract sizes that are way too large for this account because I haven't been wanting to trade in the short term as much. I mean, it's just overall been really choppy on the daily movement, and I've been swinging a lot of trades in my main account. And a small account like this, I don't really want to be swinging trades like that, especially when I think that, you know, any sort of bad news could send this down 5 points. So if I'm long right now, I think it could be really troublesome. However, for UNG, I'd like this in a macro. I already think it's near the lows, so I'm still keeping a relatively large position here. You know, we have a 180 allocation when I open this on a $1,000 account. You're talking about almost 20% of the account, right? I mean, that's a huge amount of risk for one trade due to the sizing of this account. That's why it can be so difficult to do well in a small account, because you're inherently having to take more risk with how much money you put in the trades. So despite all that, we've had a little bit of a rough start. Still very confident I could turn this $1,000 into $10,000, but it is proving to be a challenge. And that's why we call it the 10K challenge. So if we take a look at SPY, we can see that we had our 410 or 414. I can actually remove some of these other marks that we made earlier in the week. Yesterday, hopefully you're in the Discord, you caught my warnings about, hey, when Jay Powell talks, this market's going to start to move. We saw that exactly play out. However, it turned out to be a big nothing burger, because we went right back to our chop zone. And we've had a few test breakouts here, but you've noticed that even when it breaks out, market closes right back below this or sinks right back to these levels. So there's been no real true breakout to the upside from this 414. You might be tempted to say, oh, I'm going to move this up here, but actually there's been no true breakouts here. I still think the 414 to 410 range has been holding up very, very sturdy in this market. So we're going to use this as an indicator. Now, what you also want to keep an eye on, though, is this 1 hour chart right here. We can see that we're actually starting to fire to the downside. Now, that doesn't mean that we're for sure going to sell off here, but if we look at the 4 hour, we can see we're also getting a signal to the downside. On the 1 day, we're also seeing that we're starting to roll off on our momentum as well, showing that this market seems to be losing the steam that it had. And we're still sitting in this chop range, so we could see this consolidate some and then still get that final rally that people are looking for. But right now, to me, it looks like we could chop until May even at this point, and at which point at which point I'm going to break everything on my desk, at which point I'm expecting a classic sell in May and go away event. And that's all I'm going to cover for the weekly report. Now, of course, in the Discord, we've been talking about a lot of companies. I mean, Apple, Tesla, Shopify, Amazon, Meta, Google, Netflix, Airbnb, Enphase, Coin, UNG, Bed Bath & Beyond, AMC, Rumble. I mean, the list goes on and on. I've also been digging more into some of the biotech companies, CRISPR. So we're going to be hearing more about those. I think some of those are looking kind of interesting right now. I mean, the list goes on and on and on. But I've got a time constraint for these weekly reports. I'll also be putting out some more shorts. Been having a little bit of dead space when it comes to content creation because I've been working on some other projects as well. If you're a broker dealer or a hedge fund manager and you're watching this right now, I am starting a second company where I'll be doing what I do here for myself, all this content creation that I've had a lot of success with. I'll be doing that for you with my second company, Capitalize on Media. So if you want to reach out to me, the link down below through my email at nobeltrading@gmail.com. I'm running that business through that LLC. I'd be more than happy to provide my services for you. And that's actually what I've been working on recently. Now, for most of you, this doesn't apply whatsoever. You don't care. But on the off chance that you do fit my clientele for that, I've been more than happy to talk to you or even just talk to you about how to get started on your own. So anyways, hope you enjoyed this weekly report and I will see you very soon because I'll be putting out more shorts here shortly.